To only leave them with $500,000 is a full dereliction of my duty as a father.
To leave their family on the exact same life trajectory, the exact same lifestyle, not give up their hopes and dreams, pay for the house, pay for the college, still go on vacation, have some cars. They actually need. You're listening to Remnant Finance, the show that brings you unfiltered takes on unconventional strategies to sever your dependence from the banking industry and Wall Street.
We're Brian and Hans, military pilots turned economic insurrectionists and infinite banking practitioners.
We strive to keep prosperity simple. We've learned that the most important aspect of your personal financial journey is the one that is almost entirely ignored by the conventional model, the process of banking.
Our goal is to teach you how to build a strong financial foundation, growing, leveraging, and protecting your capital while optimizing your financial order of operations so you can live the life you want to live now and in the future.
Listen each week as we challenge the status quo and provide uncensored takes on finance, economics, and current events. Now, back to the show.
Hey, what's up, everybody? Welcome back to Remnant Finance. We just finished up our two-part series on Money is Not Math, and we want to get back to some basics here. If you've been listening to us from the beginning, this will sound familiar. We're going to re-hit a topic called human life value. We have episode number 4. It's called What Are You Worth? We're going to cover a lot of that same content today because we've gained a lot of new listeners since then. And it's something that's kind of a core foundational concept to grasp when we're starting the conversation about how to think through the planning discussion. Because it's so important, we're going to double tap it and it'll sound familiar. Maybe listen to that one and then listen to this one. A lot of the similar information, but we just want to make sure that everyone who's listening is exposed to this idea, given its importance. So what's new, Brian?
Yeah, no, nothing new. Finally sold the other house, so it's like one thing off the plate, one massive thing, but nothing major new, man. Just as far as this human life value, it actually touches on a little bit of what we talked in the last 2 episodes, because there we were talking about how like the standard plan is for scarcity and living to your maximum human potential. That was like right when I got cut off at the end with my faulty equipment. But I was kind of talking about maximum human potential. Like we want to maximize almost everything else we do in life. The retirement planning system seems to not do that. But hearkening back now to what we do, we're going to talk about maximizing our human life value when it comes to what you insure against the most important asset you have. So I always love this discussion. I think it's one of the best I ever have with anybody.
Absolutely. It's really helpful when someone schedules a call and it's our first time talking to them, if they have listened to the podcast, because you kind of have a foundation of understanding these concepts. And that's really the purpose of this is to get that kind of hammered in. So with that, we're going to talk through, starting off, the 2 different types of approach that people take when they're talking about life insurance. The needs analysis versus replacement approach. So in a nutshell, what's the main difference there?
Well, needs analysis, it's sort of like forward working, I would call it, where they kind of say like, okay, so how much money does a person make? How much are you going to need whenever for college? How much do you need to pay off your house? And it's usually looking at like a minimal amount that people can use just to get by, or just to get out of debt, or just to overcome some sort of hurdle. And even if you do that and you put life insurance on a loved one's life, if you're the breadwinner, or if it's on your spouse, or if it's on your children, it's still going to be helpful. So I think it's the wrong approach, but it's a better approach than doing nothing. But it's just kind of like looking forward, like your kid's going to go to college. How much do you think you're going to need? I don't know. And we kind of run into that same sort of thing again there.
And our examples are always going to be geared towards fathers. That's our main audience. That's what we are when we're having these conversations. 90% of the time, it's talking to fathers. And so if we have someone that is coming to us to get insurance and set up infinite banking, thinking about the living benefits, all of the stuff we talk about pretty regularly, at the end of the day, we always want to bring it back to this idea that what matters most when we're looking at this illustration, we get focused on cash value, the growth year over year, et cetera. But that far right column is what matters the most, because there is no cash value without this death benefit. The reason the cash value and everything we do while we're living is tax-free is because that death benefit is tax-free. And that death benefit is tax-free because it's so important that the government actually says that this is so pivotal that this is not taxable in an effort to get people to purchase more life insurance, because it's so valuable to be able to protect your family. So when we're thinking about your family and you're thinking as a father, you are the insured. And so why why would we say, okay, I'm the insured, my insurance amount is going to be based on my income. It's going to be based on my, or as far as the underwriting for the insured is going to be based on their income, the ability to pay, what they're currently making, what they're worth. Then we shift that all of a sudden. We say, okay, rather than focusing on you as the asset that we're insuring, let's set the amount based on someone else. We don't do that with any other type of insurance, but in life insurance, we have this idea that all that matters, like you said, is can we just make someone break even on debt when I pass so that my family doesn't have additional bills, which certainly is better than nothing. I'd rather leave my wife enough to pay off any outstanding debt, get to even, and then pass her whatever assets. That's better, but I would much rather pass her what I'm actually worth if I die early, because the chances that you're going to die before you retire are statistically very, very low, which is why, for instance, term insurance is priced so cheap. And so you're very likely going to make it to retirement age, but we want to make sure that in the event you don't, that entire amount is covered. Now, we'll get into the difference term versus whole life. That's a whole discussion, but you should, at least till you are, while you are working, you should have one or the other in place so that, and we want to make the case for human life value, that is the more important metric to measure yourself by. So in a nutshell, what is human life value?
Well, human life value, to put it as simply put as we can, it's something that really the insurance company is going to calculate on somebody's life. And they'll do it in a couple ways, but the one that applies to most people and that is going to be applicable to almost everybody that listens to this is they're going to look at your age and they're going to look at your income and say, so based on what we know, how much income do we expect this person to bring in? So if you're 40, they'll probably use a multiple of 20. They typically do 15, 20, and 30 as multiples of age. And so they would multiply what you're making times 20 and say, so the value of based on the income you're bringing in. So your human life as like a labor source or as a source of value that earns money is going to be 20 times that number. For easy numbers, if it's $100,000, they're going to say 100,000 times 20 is about $2 million. So that's the amount of income based on everything we know from your history and from your current place in life that we expect you to earn. So that's how much we'll insure because we're insuring against your ability to produce. And so I like the term better economic value, economic life value, but essentially that's what it is. It's actually a pretty simple thing. And when you think about why we think it's important is everything else that you insure to its true value. Your home, your car,
Yeah.
jewelry, you name it.
Yeah, absolutely. And I think economic life value is a better, I kind of like that more as well. And that, because when you say human life value, it kind of implies that you were just distilling your value as a human down to a dollar amount, which is not the case. Of course, you are irreplaceable to your family and those who depend on you and those who love you. It's not like money is going to fill that gap when you pass, especially if you pass early. But they have to call it something. They have to figure out your value. If we're going to insure something, that something has to have a value. In this case, it's not that we're just insuring your life because people love you and depend on you. We are insuring you as an asset. And we run through the balance sheet of most people and they list out all their assets. Most are going to say my house, a paid off car, a stock portfolio, whatever is their most valuable asset. But we got to emphasize over and over, you as the income producer, your ability to go out and reliably earn X number of tens of thousands of dollars, whatever your salary is, that is the biggest asset that you bring to the table for your family. And so economic life value is kind of a better term for that. And you'll hear them interchangeably, both from us and just from the industry in general.
Yeah, and actually, what's wild about it is while we talk about them, we're calling that their economic life value. Even if you fully insure all the way up to that, for most people with a mixture of whole life insurance and term insurance, you're probably underinsured because it's just a present day calculation. It's not considering everything that's going to happen in the future. And I'm going to try to share this screen, and we can actually, to separate a little bit from what we did in episode 4. Let's actually show some numbers if you're down with that.
Let's do it.
Let me share the screen here. We'll talk through it as best we can. This is Truth Concept software, created and owned by Todd Langford. Phenomenal software, and it's a little bit. It's not. I wouldn't say it's challenging to use, but it is just so in depth that you can. It really crunches numbers better than anything else I've seen out there. But so I just picked a random person. I literally just typed this in as you were talking. I said, let's use somebody that's age 40 and who earns $150,000 a year. Is that a fair number? We can use more or less. It doesn't matter.
Yeah, I mean, if you're a military officer, which a lot of our clients are, that's very accurate at
It's pretty
40
fair.
years
Okay.
old. Um, Airline
So
pilot, it's probably a little low, but yeah, it's a good average.
the point is like what this is going to show will scale based on what you make. If you make 50 grand a year, it's going to scale similarly, and if you make $300,000 a year, it's still going to scale in the same way.
Mhm.
So let's illustrate this out for 3 years or 30 years. Just because by the time the person is 75 years old, they're likely done earning income. They're done. Their family isn't going to need their full economic life value potential at that point. Their kids are probably gone. So I'm going to cut it off at 30 years. And we said this person's 40 years old. All right. So they make $150,000. But I'm going to open up here this tax chart. I've already punched it in. And I somewhat arbitrarily said that they have a total of $30,000 of deductions here. So you can see their federal income taxes. I'm going to round it up to $17,000 a year. So using that, just so anybody watching sees what I'm doing, we're going to take the federal income taxes off and say then that they have $133,000 a year that we need to account for. That's the cash flow coming into their life. Good enough?
Sure.
All right. So I'm going to come back to this. So the way I'm going to do this is the cash flow coming in that would need to be spent, I'm going to make it a negative 133,000. So if you are going to be spending $133,000 every year, that's the spendable cash that's coming from your salary, which I'm probably overestimating. It's probably more like 120. I could have just used that number. Notice how much money the person needs to start to fill that bucket and account for your income for 30 years. They need to have almost $4 million. Will that be enough though, Hans?
No, because we're assuming that I guess in this example we're assuming that this is what they're living on right now.
Hmm?
The major assumption here is this stops at age 70.
And
So
I think the other major assumption is that you never, when in your life have you ever not earned a different amount of money from the year prior?
yeah, never, especially in the
Typically
military.
high, right? So let's
Yeah,
make this person a salaried person. Could you expect a 3% increase per year about for somebody on
yeah,
salary getting a raise?
yeah. I'm looking at this. To me, this person is an '05 in the military. Um, at age 40, that's probably pretty accurate. This is probably pretty accurate salary here, and the salary increase 3%. Like this to me
Yeah,
is
so
lieutenant
assuming this
colonel.
person leaves and makes more to accommodate the increases in income that would have come their way, they actually need $6.3 million dollars if they were die today to leave their family on the exact same life trajectory, the exact same lifestyle, not give up their hopes and dreams, pay for the house, pay for the college, still go on vacation, have some cars. Now it's and then you can make an adjustment from there because that person's now dead, right? So the cost of their life has gone down. So you can kind of work those numbers for what the family needs, but you can see that even when using the life insurance company's economic life value or their human life value, the calculation they do, it far short of what you probably really need when you consider things like increases in income. Is that money going to earn something? So now I can even add that in. So let's say we could get 4%. That just changed everything. What if you can only get 3% like in an environment we had at another time? So my point is whatever you think you have and whatever you're capable of buying in economic life value, it's probably not enough. And so we need to at least meet what the insurance company is willing to do
Yeah, and
to
if
secure our
I'm doing
family as
this,
best we can.
if I'm looking at this, for me, I would remove the earnings rate because I would, if I'm devil's advocate, it's we're not going to be
Me too.
making 4% on 133 grand that we make. Like if we make 150 and we take home after taxes 133, we're not putting that all 133 in the market, making whatever. So I don't even think the earnings rate is pivotal here. What is pivotal
I
is
agree.
that going from assuming a flat no raise situation from 0 to 3% was over a $2 million difference in need. Now, the other big thing here is this spends that money. This says we're going to spend that money. So with the 3% raise, that that 6 million you need, and probably going to be a little bit less than that because at a certain point, the last 5 years or so, maybe you're not working, so maybe we're not actually getting those raise increases. But we'll call it around 4 million that you need of income in order to maintain your current spending, your current lifestyle. That assumes that you're spending this account down to zero by age 70. So
Right.
this plans for the full failure and being broke at age 71. And that's not, that's not realistic. Of course, we're we're, we're inherently going to make a lot of assumptions in a calculator like this, but this is just to show you the magnitude. And let's say Lieutenant Colonel Ramsey here has his SGLI, which is $500,000 of term insurance that you get from being in the military, which honestly, in my conversations, including myself, starting with the first 10 years of my career, in my conversations with people that are military officers, it is much more common that someone only has SGLI, service group life insurance, the $500,000 that you're automatically opted into, which will expire when you get out of the military. It's more common by a long shot that someone only has that than it is someone has that plus other insurance in place. And so if you're in that situation where you know, assuming a terrible plan of spending this down to zero by 70, you need $4 million or $6 million if you count the increase in earnings that you're going to get as a military officer. If you're in the situation where you die on that first year there, age 40, and you leave your wife with $500,000, she is now out the millions of dollars you would have made. So this is such a
Yep.
powerful way to flip your thinking about it. I think I've made this point many times on the podcast, so this is going to sound familiar. First 10 years of my career, before I started talking to Brian, before I started diving into insurance, before I started trying to challenge the idea of infinite banking and came around to the, like, this is not challengeable, it was, if you had asked me if I had life insurance, I would have thought that it was 400,000 at the time of SGLI. That's a big check. Who wouldn't love that? That's going to be great. It's appalling to me to think now how exposed I was leaving my wife. And by the time we had kids, had already kind of learned this and wasn't in that situation anymore. But can you imagine if just to maintain the current lifestyle that we have, I need to account for $4 million over the next remaining of my working years. To only leave them with $500,000 is a full dereliction of my duty as a father.
Yep. I agree. Yeah, I agree completely. And you guys also have to think like when you give somebody here's another thing as the leader of your household. Let's say I could accommodate this. Have I equipped my family, since I'm the one that handles most of the money, to know what to do and how to handle that large income? So we're also assuming that these people are even doing this plan, like, hey, I'm gonna equally distribute this over the years so we can keep our lifestyle and spend it down. We could grow this, or that could all go wrong and go to zero. So
Yeah.
I'm just saying, I think that as a steward of the money and the leader of your household, you should also be preparing your family for an inevitability that, I mean, we don't know when that inevitability is, but someday a massive amount of money is going to come your way. How are you going to handle it? Are you going to squander it? Are you going to grow it? Or are you just going to get by with it? Because that's a large number. Now, since we can't get insured for this number, this 6.327, I'm going to stop the share now. What's a way that we can bridge that gap? What I'm thinking about is the fact that while the insurance company won't write that much on us, one of the ways that we can have some level of mitigation, and that mitigation grows over time, is having dividend paying insurance. Because just like Nelson says, if we are with a mutual company that pays dividends, we contribute to the company, we're benefiting from the profits of the company. Over time, those dividends are going to continuously pay into more paid up additions and buy more insurance. So you're always like, there's like two axes there. One, you're way short and you need way more, and those are going to flop over time. So you're most exposed when you're young at human life value, and in dividend paying whole life insurance. As those dividends pay, as your death benefit grows, you're eventually going to get to a point where you have more death benefit than they ever would have written on you, and you're better approaching that actual necessary number. So there's always like this risk point of not having enough.
Mm-hmm.
But if you're in the right insurance, the two axes are going to cross at some point, or the two
Yep.
lines. Yeah.
When I last did this calculation on myself, um, I was worth $5 million, And so I got my whole life policy. If I look at the illustration for my whole life policy, it's $1 million death benefit. Ballpark is the starting out year one death benefit, a little shy of that. If I fast forward to age 70, it is over $5 million from the factors that you talk about. And if that sounds crazy, then you just need to learn policy mechanics with us, and we'll walk you through that, and we can show you. But as we grow over time, as we start adding on more of these policies, in my case, that roughly speaking, of my $5 million of human life value, economic life value, 1 million of it's captured with whole life. That's my IBC policy, and the other 4 million is captured with convertible term. Term is cheap because you're very likely going to outlive it. You don't want it to ever pay out, and so I want to outlive that, but I can convert that to whole life. And every time I do that, I convert that chunk. Let's say I do a $500,000 conversion. I take a chunk of my 4 million of term, 500,000 of it. I move that over and start a new whole life policy. Well, that death benefit starts at 500, so I'm a 1-for-1 replacement there on my current snapshot. But now that 500, because of the dividends, the same factors that we talked about, is going to grow over time. So I could get to the point where I am way over what my human life value calculation was in 2023, let's say, and far surpass that. And so that is a very powerful way to do it. If I look at, so I've got my one of the CLU course textbooks here, Tools and Techniques of Life Insurance Planning, and I open it up to the how to estimate the life insurance need, and it talks about the two strategies here. But if you look through the human life value calculation, it's like 12 pages of charts and tables. You're calculating future and present value. It gets so in the weeds. Like, if I'm here, I'm earning this, I'm also earning these dividends, I'm also earning this and this and this, but then I'm taxed at this. And so you're taking all of these things, these components, and adjusting them both, like either adjusting current values to the future, or taking future values and backdating it to your age and saying that if you had missed those, it's a very complex calculation, and it doesn't really need to be, because the intent here is to get the actuarially precise amount of life insurance by both metrics, and both metrics are very complicated. But when we talk to people, our clients want, who understand what we're trying to do, understand that this isn't just a cost. What they want is, I want as much as I can possibly get. We fast forward to your last day on earth, whenever that is. We know you're going to die tomorrow, whether you're 40, whether you're 70, whether you're 90, whatever. And we ask you one question: how much insurance would you get if you could get more today? Well, you would put every dollar you possibly could into life insurance, right? Because that's going to multiply and pay to your family tax free. Now, that, of course, that's very simplified, but the idea is, when you're dying, the asset you want the most of is life insurance, because of the tax free, because it skips appropriate, all these benefits. So we simplify it. We typically go with 65 minus your age times your current income. That gives us a ballpark. The company, like you mentioned, takes 15 or 20 or 30 times your income based on an age range. Both the companies simplify it, we simplify it. The textbook is pages and pages of calculations that honestly we're never going to do, because we just want as much as we can get. I want 100% of what I can get, and I would rather over insure by that metric, where I don't want to back out the taxes. When you went from 150 to 133, because, okay, well, if I'm not making that income now, I'm not paying the 17 grand in taxes, and therefore we're only focusing on 133. If it's me, I'm going to take that 150 to apply the calculation, because I want as much as I can possibly get.
But I want to show this to the person so that they're thinking like even just the cash flow my family needs. So I did that on purpose. But
Yeah.
yeah, I would use the 152. And as a matter of fact, I've actually seen the insurance companies typically just use gross income.
Yep.
And when I took that course for the same one with that tools and techniques of life insurance, the other thing that I found interesting, or especially when you're doing that course, you watch some videos, and while they talk about human life value, the emphasis in the industry is needs based approach.
Yep.
And I think that that's an absolute travesty for a lot of people, although like we've said in the beginning, it's better than having nothing. But
And that's because nobody is having the conversations we're having. They're viewing it as,
yeah,
what we always say is, this is not a one-way budget item expense. This isn't just something that gets deducted from your checking account, goes out the door, and one day your wife will get the benefits. Like, no, we're funding a bank. We understand all this, so we don't view it as an expense, and therefore we're not trying to whittle it down as low as possible. But in that idea of needs-based analysis, if you really want to whittle down your premium to as low as you can get, then it makes sense why you might do a needs-based analysis. You might do a technical human life value calculation and back out as much as you can to get that premium down. But our input is the premium. I want to pay as much premium as I can into this system because of all of these living benefits I get in the meantime, not
Yep.
just what's the lowest I can pay to fund a death benefit.
And I know we talked about it because I brought it up so many times, but I'm always fascinated, especially like you mentioned the SGLI stuff and in the military community. There is just such a I've heard this more times than one now over the years where it's like, well, I have enough that my wife will be able to pay off the house or, be out of debt if I die. And it just that is such a scarcity minded thing. Like, and that's like this needs based, like, well, she needs to pay off the mortgage. And I just always counter that with, I know this is gonna be a repeat for some people, but like, is the reason you go to work 40 hours, 50, 60 hours, the reason you deploy all the things you do just to pay the mortgage? Like, is that why you do that?
Yeah.
Or do you do it to provide everything for your family? Or you like you're putting food on the table, you're going on vacation, you're buying vehicles, you're having experiences, your kids are playing sports, you're going out to dinner, you know, you're buying clothes, like you have an entire life. It is literally has nothing to do with just the mortgage, which is probably the least of her concerns. She'll figure that out with you gone. Like, how am I going to still get the kids to college if that was a goal? How am I still going to provide for them and give them experiences growing up? How am I going to put food on the table for the next 18 years? Like, our income is for so much more than a stinking mortgage. And that is just that phrase has come up in my career multiple times. Like, oh, I just want them to be able to pay off the house. Like, why is that the concern? It costs you 1,500 a month right now. You bought your house 15 years ago at 2%, 3%. Like, is that really the biggest hurdle she has? Is your $1,500 a month mortgage?
Yeah, when we talk about, I mean, this isn't a discussion about mortgages, but it it very rarely makes sense from a net present value calculation perspective to pay early on your mortgage, especially if you have one of those golden goose 2 to 3% mortgages from a couple of years ago. And
Yeah.
so if I have the money to pay off my mortgage and I have a 2 or 3% mortgage, or I have an ability to earn greater than what my, what it's costing me to keep that mortgage, like I very likely would not pay off a mortgage even if I had the capital and I'm alive to do it. So why would I think that I would make more sense for my wife to pay off the mortgage? But anyway,
Right.
that's not the purpose of this. Just this kind of wrap up the human life value versus needs analysis conversation. There's a couple good paragraphs from Bob Castellan, who's the founder of the Leap system, which is a way to kind of put all your assets on paper and sort of see how they interplay with each other. But in a book, he says everyone should own life insurance. Everyone has a value, and everything of value should be insured against loss. Every adult is an asset, whether he or she owns a business, works for someone else, cares for family members, cares for the home, or does a combination of two or more things. The value an individual produces in his or her life is an asset and should be insured. You may read in the financial media many articles about life insurance and how to determine the need for it. Many financial writers have stated that you may not need any life insurance, especially if you are only a housewife. The best advice I can give you is to completely ignore them. They do not know the harm that they do to people by giving such bad advice. It's unfortunate that most life insurance advisors have been improperly trained. They have been trained to determine the amount of insurance a person should own by using what's called a needs analysis calculation. If you hear the word need in any conversation or see it in any written material about life insurance, you immediately know that the person using such a term has little knowledge about life insurance and how it works. Why do I say that needs analysis type planning is inappropriate? I say it because no beneficiary or survivor, given the choice, would want only an amount of insurance that they supposedly need rather than the true value of the insured person who died. Insurance companies will insure individuals up to their true value. That amount is the most that they will offer. You can't get more than that amount, just like you can't get more home insurance than what your house is worth. If your house burned down, you would want full value, not less. When a person dies, the beneficiary would not want less money than what the deceased was worth. Why would the beneficiary only want what was needed to make ends meet and leave the true value of the insured for the insurance company to keep? That that gets to the idea of you insure your car to full value in part because it's required. You insure your home because it's required by the mortgage, but you have these assets that you maintain 100% full insurance on, right? And all of us have those things fully insured. They're not certain to actually pay out. I've never totaled a car and I've never had a house burned down, yet I maintain those things. I live in Southern California. I have fire insurance. I drive a car. I have car insurance, but I've never totaled a car and I've never filed a claim for earthquake or fire or any of those insurance. But I have to have them. I want to have them for 100%. But I
Or,
know
or,
what's that?
or any of those your greatest asset?
No. And I know my greatest asset is going to, quote, burn down. I know I'm going to total my life, i.e., I am going to die. If you're listening to this, you have ears and you're a human, and then you are going to die. If you are
Period.
going to die, guaranteed, when that happens, would it not make sense to be fully insured on that asset that is
Yeah.
currently your most valuable asset? It's a
And it's
different way
also,
of thinking, but it's important.
and that also speaks to like why whole life insurance is an actual asset, is because it in the insurance industry across every other thing you can insure, you're always insuring against some potential risk.
Right.
For your home, you're insuring against the potential for a fire. I've never had one either. My parents never had one in their entire lives. Like my next door neighbor, as a matter of fact, did have one where I currently live. Like it happens. It's a possibility, but it very rarely happens. You're insuring against the possibility of an accident. When it comes to whole life insurance that's going to last your whole life, it has to be an asset that has a real value because it's insuring against an absolute 100% inevitability. You are going to die. And it's the only type of insurance I know of that is not if, but when.
Yeah. The other ones are a cost. This is an asset. It's not debatable. Banks and corporations have hundreds of million. I mean, depending on the size of the company, but a large corporation is going to have hundred millions of dollars in their asset column denominated in life insurance cash value. That tells you something. And people, this concept might be new to you. What is an economic life value? Maybe, hopefully, the wheels are turning if you're in that situation where you're worth $4 million, but you're insured for SGLI. Hopefully, that's getting you to think a different way about what your insurance quote needs are. But you might not know how to calculate this. This might be a new concept to you, but we can tell you how much you think you're worth by looking at your current insurance. If we sit down and we say, what insurance do you have right now? And you tell me I have SGLI, and maybe you've done some work with First Command or something, and you got $1 million term policy or whatever. I can tell you what you think you're worth because that's what you actually insured yourself for. It just like
Yeah. And think about this. Like you mentioned that a lot of our audience, were military officers. So let's use that $150,000. You are insured for just over 3 years of income. That's what you're leaving your family, if that's the case.
yep.
Is that all you think you're worth? Do you think you're worth 3 years of your working life? That's all SGLI leaves you. It's like, if nothing more, like they can maintain a lifestyle for 3 years and then thanks, I got to figure it out from this point forward.
Yep. There's a fantastic book that we referenced several times in the podcast, particularly in the episode about human life value, called "The Economics of Life Insurance" by Solomon Ebner. If you want a real truflation gauge here, the sticker on there says $1, and I paid about $200 for this. It's hard to find right now, but he kind of, as far as I know, he kind of came up with this idea because it is something that, like we said, the company has to put a dollar amount on your worth, and we've made the analogy before. Most of us are McLarens driving around insured like we're Corollas, right? If I have a Toyota Corolla, I cannot go get $1 million insurance policy on it because what I'm going to do right away? I'm going to total it, right?
Yeah.
And then get the payout. But conversely, if you have a McLaren and you insure it for $30,000, you feel terrified. You're not going to drive down the road. Like, you feel terrified, right? So that's a good analogy there. So he kind of coined this idea of how does a company measure and actually put a value on your life. So he has a couple good quotes here. It says life insurance is concerned with the organization and management of the economic value of human lives. That value may be defined as the capitalized monetary worth of the earning capacity resulting from the economic forces that are incorporated into our being, namely our character and health, our education, training, and experience, our personality and industry, our creative power, and our driving force to realize the economic images of the mind. That is way more comprehensive than simply what does your wife need to pay off the mortgage. Like, we're saying you have all of these factors that determine who you are, and even when we make this calculation, we kind of distill it down to just your income because that's what we have to work with. That's how the company is going to measure, the value of what we're insuring. But at the end of the day, like, if you have the ability to apply your mind to new streams of income, you increase your human life value calculation, because now you could qualify for more, because that income, so it's taking in the fact that we are so much more than just a dollar amount, even though we are in this episode distilling you down to a dollar amount. We need to think more broadly about this, because it's so important to grasp like just what you're actually worth, and make sure that your family, when they are inevitably deprived of your human life, that they are not deprived of your income and your asset value.
We probably went really in the weeds on episode 4. So if this is the first time you're hearing this and you want to hear a little more in-depth discussion of it, but if you listen to both of those, you'll definitely have a pretty good grasp on it. But just something to really think about, like as as a father, as a husband, are you actually leaving your family as whole as you possibly can be? And how do you feel about knowing you might die tomorrow and, leave them effed?
Yeah. Just
For lack of a better word.
a couple questions just to take away from this episode. Like, either write these down and just think through these yourself if you're listening. If you're a father and your wife is staying with the kids and you don't wake up tomorrow, can she continue to stay at home, or does she need to go back to work? Will your children maintain the same quality of life? Will your wife know how to navigate the financial strategy you have in place, access various accounts, etc.? How confident are you that your strategy will last the rest of her life, regardless of market conditions and eroding factors and your remaining lifespan? And if you were going to die tomorrow, how much insurance would you want? If those questions are resonating with you, if you think you might not be fully prepared, and if you wouldn't, like, if you have answered those questions currently, if you don't wake up tomorrow, right, you've already put in place all of the answers to those questions, whether your wife knows it or not. You've left her in a situation. If she would be happy with what you leave her tomorrow, then you're good to go. But if you want to explore further, if you want to see where you're at and see how we can expand what you are worth and capture that value, then we can schedule a conversation.
Cool. Yep. I'm going to call this one a little short because I'm a little sleep deprived and my brain isn't working right. I'm not thinking straight. I'm not thinking quickly anyway. I'm not quick on my feet today at all.
Go back to episode 4 and give that a listen as well. Kind of combine these two together. You'll hear some repeating things, but it's super important. It's important enough that we're going to hit it twice. So
Awesome.
Give us a like, review, share, subscribe, whatever. All the things are helpful. We appreciate it. And we'll talk to you next time. Cheers. Cheers.
Thanks for listening to Remnant Finance. If you found any value at all in this episode, please subscribe, leave a review, and share it with a friend.
Remember, true financial freedom comes from taking control of your personal economy and breaking free from the status quo. So stop being a passenger in your family's financial future.
Boldly take back control of your wealth. Until next time,
this is Brian and Hans signing off.